This is a means of which you can purchase a property. This is a way to buy houses that literally there's very little credit check or anything, if none at all, if any at all. And it's simply owner finance properties. Bond for deed process is very similar. It's almost identical to an owner finance property in a sense that when you do a bond for deed, the difference is this: your name doesn't go on the title. There's a deed and a title to every piece of property. The deed shows whose ownership. The title, for quite simply explanation, shows who has the right of decision on what you can do with the property, who has the right to make the decision, who has the right to do with the property. But owner finance properties all around the country. I have literally 89,000 agents working with consumers, buyers, purchasing property, selling property this way. We have property owners that are tired of renting. They've had 3, 4, 5 renters. They don't want to rent anymore. You don't have to just sell off the property and pay one lump sum in taxes. You can actually finance that property. So when you finance the property, you're deferring your taxes that you're having to pay. So that's something to consider as a property owner. We have real estate investors that buy property this way. And here's why they buy properties this way. They buy a home. Let's say they pay cash for it. They pay cash for the home, and then they turn around and sell the property, owner financing. And here's the reason why: because the interest rate that you're going to make on that is typically anywhere from 8 to 10%. You see, it's not the cost of the money, it's the availability of the money. If you're a buyer and you just heard me say 8 to 10%, and you're thinking, what, is he crazy paying 8 to 10%? Well, my question is this to anybody and everybody that's currently renting. And listen, I honestly feel that the average person renting, and you tell me, I feel like the average person who's renting a place right now would truly rather have a home that they're buying, would truly rather have a home that they've got a yard, they can do whatever they want to with the property, they can have backyard cookouts and barbecues, and you know, if you rent an apartment, for example, you don't have a garage most of the time, so you have a house that's yours, you own. You have a garage to put your car in. You don't have to scrape your windows in the cold weather, fight the rain. But people say, wow, 8 to 10%. So you get caught up on the 8 to 10%. But the point I'm trying to make is look at the payment. So when you do these owner finance, bond for deed type properties, you're putting down 10%. Now, some homeowners, property owners that are selling the property, they want 15 or 20%. For the most part, 10% is kind of the go-to figure. That's what we see 90% of the time. The buyer puts down 10% on the property and the seller sells them the property. Your payment's going to be based on the balance. And here's what I mean by that. When you purchase a property, owner financing, bond for deed, when you put 10% down on a $200,000 house, that's $20,000. Your balance is now $180,000. That is your money. That is your money that you've put into that property. You've given that seller that property $20,000. So now your balance to them is $180,000, and that's what your payment is based on, $180,000. And it's amortized over a period of 30 years. The amortization process is a period of which time you pay back that loan. So now you have a 30-year amortization, 360 payments, right? Over 30 years. When you do these owner finance properties, you can paint them, you can fix them up, you can flip them, you can sell them. You don't have to continue to live in the property. Most of the time, the way they work is there is what they call a call period. And this is very much similar to all commercial loans. Like when you see big buildings, apartment complexes, real estate investors buying 16 units or buying a commercial building, when banks loan people money on commercial, there's almost always a call date. Like only residential properties have this fixed rate for 30 years because that's how banks make a lot of money. Banks make a lot of money. They have the big buildings. There's a Capital One building right there. It's like 8 stories tall. They make a lot of money off loaning money. They make a lot of money off loaning money on commercial transactions. The way it works with a bond for deed and owner financing is very similar to that, meaning that you have a 2 to 3 to 4 year call. So once you purchase the property within 2 to 3 years, you have to get traditional financing through like a mortgage company or a bank, if you will. And most banks are flipping their in-house loans to mortgage companies. They don't always carry them in-house. And if they do, they're going to charge you the same as like a property owner. So you're basically, you're living in the property, you own the property. And here's what's so important, if you get anything out of this quick little video, is this. when you own the property, you're buying the property, even though the owner is selling you the property and they're carrying the terms, they're carrying the note, if you will, is the term that people use in this industry. And there's a call period, and you carry the terms and carry the note, and they say, okay, listen, I'm going to carry the note. I'm going to let you pay me for the next 2 years, 3 years, 4 years. That's all negotiated and agreed upon up front in writing. And then afterwards, you're going to get traditional bank financing. And a lot of people get nervous about that because they're thinking, well, wait a minute, what do I have to get traditional bank financing, especially if you've never purchased a home before? And I tell everyone, if you've got a 620 or higher credit score, you have 2 years on the job, and proof that you have filed and paid your taxes, then you can get qualified. It doesn't mean that you qualify, because there's this other thing called debt to income ratio. They have to look at your income. They have to look how much debt you have. What are your monthly payment obligations to debt, like credit cards, student loans, medical bills, vehicle payments. It does not include like cell phones and stuff like that, which I know it sounds kind of crazy, but typically they're going to look at all that. If you filed bankruptcy 2 years ago, you can purchase a house 2 years from your discharge date. So that's important to know. But here's the big aha. Once you're living in one of these houses, think about this. Your name is on the deed, right? As the owner. Your electricity, your water, your gas, you're paying a consistent payment each month to typically a third-party mediator, which protects both you, the buyer, and you, the seller. That way, the payment goes to one person, one entity. Typically, that's an attorney, and that attorney will pay the bills in terms of taxes, insurance, and if there's a mortgage on the property for the seller. It's an actual recorded sale, and the seller can't take out liens or do any sort of home improvement liens. They can't pull any of that because it shows that there is an actual owner of the property. So they can't do any of that. So you're protected as a buyer. But it's so important to know that when you do these types of transactions, if you're out there just renting, when you rent, you pay 100%. You're not gaining any equity. That's the difference. So when you rent something, and yeah, I broker and sell real estate. I've bought, flipped, sold, done thousands of transactions, you name it. And when it comes to real estate, I do it. That's why I enjoy teaching these types of videos and sharing this information with people, so you can know and have a better understanding. And give us a thumbs up if you like this video. Be sure and subscribe to our channel, because it helps me get the word out to that many more people. When they see, oh, okay, well, that video got a thumbs up, people like that video and they got subscribed, you get it. They'll push it out to more people. But quite simply, it's a means of which to purchase a property. Now, a mortgage company is going to look at, okay, well, you've been paying your electric bill, your water bill, your driver's license is in this property name. They look at that as more of a refinance. They consider that more as a streamlined refinance whenever you want to do that transaction, whenever you need money from that transaction. Secondly, think about this. You have equity in that property. So if you're paying 8, 9, 10% in an interest payment, you have to know that even though you're paying 8, 9, 10%, you're still applying a little bit of your monthly payment that you pay towards your principal balance. So in 2 to 3 to 5 years, if you buy a $200,000 house, you put 20% down. Instead of your balance being 180, it may be 175. Also, in 3 years, that property is going to be worth more than 200. It's probably going to be worth more like, even if it increases 3%, that's $6,000 a year. It's going to be worth 212. So let's say it's worth 212, 216, 218, and you owe 175. Well, you think about that, you have almost $40,000 equity in the property, and when you have that, you're right up there with almost 20%. And when you're right up there with almost 20%, they'll give you a loan, and you don't even have to pay PMI. In which PMI is a private mortgage insurance that you have to pay if you don't put 20% down on the property. It's basically an insurance policy that the mortgage companies take out in case you default on the loan. Then they're covered, and you pay the premium like you would pay an auto insurance premium or homeowner's insurance premium. You're paying that monthly premium. That's why they say once you get 20%. It's a little bit different with FHA. Once you get 20% with FHA, nowadays, it's never taken off. So that's something that's a big difference between FHA and conventional loan. If you do conventional, you don't have to pay that. If you do VA, if you're out there, you're a veteran. Spoke with a gentleman just yesterday, called me and said, hey, I'm renting. I've been paying $2,000 a month. My wife and I are in South Florida. We want to move somewhere. We want to buy a house. He can purchase a house with no money out of pocket. You have to get the seller to pay your closing cost. It's really important to know when it comes to VA. Seller pays your closing cost. I've got 89,000 agents all around the country. We can do that for you, negotiate that for you. But the point I'm trying to make is this. If you go to WayneTurnerTV.com, you'll see more and more information about real estate. But the point I'm trying to make is, do you, be happy. I tell my daughter every day, have fun, enjoy life. Life's short, make good decisions, and renting should be temporary. It should not be permanent. It's no different than when I tell people, people say, oh, I'm down on my luck, or it's hard times. Or listen, because it's hard right now for real estate agents out there. They jacked the rates up, and the rates went up pretty quick, pretty fast. And then you have some states that are around, like South Carolina, the bordering states around a lot of water, Florida, where we've had hurricanes, Louisiana, Mississippi, Alabama. Homeowners insurance rates have tripled, just like everything has gone up. But it's really tripled when you have had a hurricane that come through 2 years ago, or tornadoes, or anything like that. Insurance has gone up, property values has gone up. We're still not seeing drastic decreases in home prices. Values are staying stable. But for the most part, if you're going to buy something, it's worth a look. It's worth a try. It's worth an ask. That's why I tell people you can book a call with me by going to contactwayne.com. Once again, my name is Wayne Turner. I've been brokering real estate for nearly 30 years. You can go to contactwayne.com, schedule a 10-15 minute call with me. I'll talk with you. I'll share with you, some tips, pointers, what to do, what not to do, what to say, what not to say. All of that good information, so you can make the best informed decision when it comes to buying your next piece of real estate. Thank you for watching. Be sure and subscribe to the channel. Give us a thumbs up. Let me know what you think about these videos. Comment below. Have you bought a house this way? Have you bought a house owner financing? Have you bought a house bond for deed in our local Louisiana market? If you're in our local Louisiana market and you're watching this video, you can go to NOLAbondfordeed.com. You can see every single home available owner financing bond for deed in our entire metro New Orleans area. NOLAbondfordeed.com. And if you're out there and you're not in the state of Louisiana, then we can still help you. It doesn't matter if you're in Atlanta, Minnesota, Pennsylvania, California, you name it, Nashville. We've got agents all around the country that can help you purchase properties just like this. What's also really important is when you purchase a house, it's like owner financing. When that house is empty, like it's vacant, you can close in a week. We had one closed. They wrote the contract on Thursday. They closed on Monday afternoon. Thursday, Monday afternoon. So yeah, start thinking positive, thinking ahead, look forward, see it, believe it, do it, act it. Everything is temporary unless you allow it to be permanent. People say, well, I'm poor, I'm broke. And I tell people, poor is a mentality. Poor is forever. Broke is temporary. You're not poor. No one's poor. You may be a little fractured, a little broke, if you will, but it's nothing you can't pull yourself and get yourself out of. Believe you me, I come from very humble beginnings, and I have pulled myself up, and I've had to do things that I never thought I'd have to do. But at the end of the day, I always tell myself, it's just temporary. It's just temporary. Everything you're going through is just temporary. Once again, thank you. I'm Wayne Turner. Make it a great day.